Welcome to Under the Basswood Tree podcast with Basswood Counsel. We break down the latest in tax law, cross-border deals, and M&A to help you build and scale your business with confidence. From international tax planning, developments in AI governance and regulations, to venture capital trends, each episode delivers focused insights you can use. Let's get started.
Welcome, everyone. My name is Gina, and this is Chris. Today, we're going to talk about expatriation and the U.S. exit tax. So, what's the deal with the U.S. exit tax? Let's think about it. You've decided to break up with the United States. It could be the changing tax laws. It could be the political drama that's going on right now. Or maybe you just fell in love with another country like Switzerland. Whatever it might be, in the end, you want to break up officially with the United States. And especially because the U.S. is one of few countries that require you to file an income tax return every year. You might want to officially renounce your citizenship so that you don't have to file an income tax return every year. The process of expatriation is not so simple. On the administrative side of things, you have to be a citizen of another country before you renounce your U.S. citizenship. You also have to make an appointment with the U.S. embassy or consulate. You also have to pay some fees, sign some documents, and you have to personally show up at the interview and swear an oath that you want to renounce your citizenship. So after you take all these steps, it's still not over. There's the realm of U.S. exit tax. The year you renounce your U.S. citizenship, you have to file with the IRS a final income tax return and also what's called an expatriation return. On the expatriation return, you need to provide certain information to determine whether you are subject to U.S. exit tax. So now, Chris, what is expatriation and U.S. exit tax under the U.S. tax code?
Well, I actually don't know because no American would want to give up their U.S. citizenship or their green card status, right? All right. So yeah, expatriation is the individual's decision to renounce their U.S. citizenship or to terminate their long-term permanent residency status, also known as the green card. Again, why would anyone want to do it? I mean, that's you're an American, right? But you know, as Gina got into, the U.S. is one of a few countries that taxes their citizens and tax residents on worldwide income. That means even if you live outside of the U.S., you still have to pay income tax to the U.S. You know, there's foreign tax credits, ways to mitigate it, but that's a burden. And the U.S. has special tax regimes for foreign income and foreign assets. And that can be very burdensome. So these people who have limited connection to the U.S. at this point, they have a much more difficult tax return to file. And so this leaves a lot of people, you know, whether they have other reasons, America's the greatest policy we might have now. But, you know, the taxes are also a big driving factor in people renouncing their citizenship and terminating their green card status. And so to get rid of to exit the tax system in the U.S., you have to file that expatriation return. And what that is you're treated as selling your assets the day before you actually renounce your citizenship or you terminate your green card status. Now, you got to be careful because a lot of people might just say, "Oh, I'll remain a U.S. tax resident until the end of, let's say tax year 2025," and so they start being treated as a non-resident the first day of 2026. Well, you would think possibly that you would pay that exit tax in 2026. But that's not the case because it's the day before you expatriate, so you're treated as selling your assets the year before, and that can be, if you don't time that right, there could be penalties. And so, it's what you do is most of it's going to be capital gains. It depends on your assets, but you're treated as selling everything. To the extent there's gain, there'll be some tax with some rules as long as you meet the requirements. So, Gina, who's subject to the exit tax?
Yeah, good question. So not everyone who expatriate are subject to the U.S. exit tax. It applies specifically to what's called covered expatriates. So there are three key tests that you must meet, either one of the three tests that will make you a covered expatriate. So the first test is income tax liability test, which you will meet if your average income tax liability for the last 5 years exceeds a certain threshold, which is $206,000 in 2025. And secondly, there's what's called net worth test, and you meet this test if your net worth, which is worldwide assets minus liabilities, is $2 million or above at the time of your expatriation. However, there are exceptions. For example, individuals who were born as dual citizens or individuals who relinquished their citizenship before they turn 18 and a half under certain conditions may not be subject to the exit tax. So these are rules for U.S. citizens, but what about green card holders?
Well, yeah, and I want to point out a couple of things. So for the income tax liability test, that's indexed for inflation every year. For the net worth test, that $2 million is not indexed for inflation. So we commonly see it's the net worth test that causes the issue with our clients who might face the exit tax. What about green card holders, right? There's people that can become citizens. No, joking aside, green card offers a wonderful way to enter into the U.S. The same three tests apply to green card holders. So they would have to meet the income tax liability test or the net worth test or the tax compliance test. And then they would be subject to the exit tax. In addition, they have to have held the green card for 8 of the prior 15 years. So essentially, more so you can just think of it, they've had that green card for 8 years. Now, of important note is under U.S., so typically a green card holder is automatically a U.S. tax resident. Under U.S. income tax treaties, that's not necessarily the case. A U.S. green card holder who's living outside the U.S. could make a treaty election to be treated as a non-resident for U.S. income tax purposes. I only point that out because if they make that election and the person has held the green card for 8 years, they trigger the exit tax. So could be a surprise. I also understand there could be immigration implications if you want to keep your green card and you try to claim non-residency tax status for your income tax. Now, I haven't been told a great answer, but I'm not an immigration attorney, so I'll leave it there. And, I'll turn it over to you, Gina.
Yeah, so we now understand who may be subject to U.S. exit tax. So how do we calculate U.S. exit tax? So as Chris briefly mentioned, the exit tax is imposed on your worldwide assets as if you sold them on the day before the expatriation date. So this is called mark-to-market rule under the Internal Revenue Code Section 877A. So for covered expatriates, this means there's a one-time tax imposed on the net unrealized gains as if you sold all of your assets on the day before the expatriation date. And there's actually an exemption amount that applies to the tax burden, which is $890,000 in 2025 and $866,000 for those who expatriated in 2024. So, Chris, must the covered expatriates pay the exit tax at the time of expatriation, or can they defer tax?
So covered expatriates, they can make an election to defer tax on an asset-by-asset basis. And so this is important because not everyone, it's easy if you have a house, potentially meet the net worth test of $2 million. Maybe your house is $1.8 million of that. And so just because you have, $2 million in net worth doesn't mean you have liquid assets, cash, marketable securities to pay this tax. And so on an asset-by-asset basis, you can elect to defer tax on those assets. And then you would pay the tax when the asset is actually sold. But there's interest charge to that, and you have to waive treaty benefits that might otherwise be applicable. So, to ensure there's adequate security is available, it's additional hassles and strings attaching you to the U.S. after you're just trying to get out of here. So that's one opportunity. And then there's certain types of accounts, mainly retirement accounts, where instead of being taxed under the exit tax on it, they're going to impose a 30% withholding tax in most situations. That's another area where there'll be some continual obligation. The nice thing about withholding taxes is that's on the, let's say the 401k carrier to administrator to do the withholding tax. You don't have to file a tax return usually. And so, yeah, you make these elections at the time of you filing that expatriation return.
So when they expatriate, after they expatriate and they receive some U.S. income, does that mean the covered expatriate will need to file an income tax return whenever they receive income, such as the distributions from the retirement accounts?
Yeah, correct. Well, distribution of retirement accounts may or may not. If all the withholding tax is applied, then you don't necessarily have to file the tax return. But when it comes to other U.S. source income, so the covered expatriate, after their date of expatriation, turns into a non-resident for U.S. tax purposes, unless they did something odd where they expatriated and then they just stayed in the U.S. And I've unfortunately seen that happen. Like, kind of defeats the purpose, because if you meet the U.S. residency test, you're a tax resident. And so you paid this expatriation tax, even though you're going to still be, subject to U.S. income tax on worldwide income. Now, moving to your question, the typical situation where the person's living outside of the U.S., they're considered non-resident for income tax purposes. This means they're subject to U.S. income tax on income that's effectively connected to a U.S. trade or business, and that's on a net basis. So income minus losses or deductions, and that's taxed at the graduated rates that we're all used to. For other income, which is called fixed determinable, annual, and periodic, more passive income, rental income, dividends, that's going to be taxed on a flat basis, usually 30%, and that's from U.S. sources. So dividends from U.S. corporations subject to tax. If you're living outside the U.S., for the most part, you will not be subject to capital gains tax, even from U.S. corporations, unless it's the sale of U.S. real estate. So capital gains become more favorable to the non-U.S. person, to the expatriated individual. And then interest income, a lot of interest income through what's called the portfolio exemption is exempted from U.S. tax. So people can actually invest in the U.S. on a much more favorable basis. There's some estate tax implications you have to be concerned about. But yeah, so that's really the tax regime you move into once you expatriate from the U.S.
Yeah, so those who expatriate, if you continue to have brokerage accounts in the U.S., then you have to think about what type of taxes you're going to be taxed on even after you expatriate. So just keep that in mind.
And I would say, of key planning considerations. So we have the exit tax itself, right? So we're going to treat you like you sold all your assets. And this is interesting. It's a deemed sale, right? Mm-hmm. And so if you're living in another country, that's not a real tax to them. And so then you have to think through, okay, the U.S. treated tax that individual as if they sold those assets, right? Now that person, let's say they're in let's say Europe, they have a 50% tax, let's say, and now they actually sell those assets, like as the stocks. Well, they're going to be subject to tax, and there's a good chance they don't get a foreign tax credit. So that this exit tax also leads to double taxation. Correct. But there's the other implication to think through is, all right, maybe you expatriate, but your children or people who are going to inherit from you remain U.S. people. That has its own set of separate rules and tax treatment that if they're U.S. people, whoever's inheriting from that expatriated individual, the tax regime is not very favorable. Yeah. Can you tell us a little bit about it?
Yeah, so this is a provision related to U.S. exit tax. So Internal Revenue Code Section 2801, which is commonly known as covered gifts and bequests tax. So this is another type of tax imposed on U.S. citizens, residents, and domestic trusts who receive gifts or bequests from the covered expatriates. So the U.S. does not impose inheritance tax. We're in the estate tax regime. But this is essentially an inheritance tax imposed on the U.S. recipients who receive gifts and bequests from or inheritance from the U.S. Covered expatriates. So the tax is applied to the net value of the transfers, which is the total value of the gift or inheritance minus the annual exclusion amount every year. And the exclusion amount is currently $19,000 for 2025. And the tax rate that applies aligns with the highest federal estate and gift tax in effect at the time of the receipt, which currently is 40% right now, which is quite high. Notably, this tax applies regardless of whether the covered expatriate received or acquired the property before or after the expatriation.
Well, what's that? I mean, you may say 40% is high. That's actually low in the history of the gifted estate tax exemption. I mean, for a long time, it was 55%. I think it was higher even before then. It fell to 35% for a little bit. And it's one of these policy things that goes on in Congress. What should that rate be? But it's really important for this covered expatriate because, 35% compared to 70% is a huge difference because it's a gross tax. It's not a tax on the gain. It's a tax on the gross value of the property inherited, right? Mm-hmm. Well, what about the exemption? What exemption do this expatriated individual get? So they don't get an exemption, and that's problematic. So you can say you're trying to equate these individuals on what they would have paid in transfer taxes, estate gift taxes, if they remained in the U.S. Mm-hmm. But that's not. There's no. The U.S. person gets close to $14 million exemption, $28 million between spouses. These people are paying it on $1, right? And so that's a huge impact if your children are going to remain U.S. people. Another issue why they're not treated equally, the gift tax is tax inclusive, meaning the person receiving the gift, if you gift them $500,000, they get $500,000 because the person who made the gift would pay any tax. For covered bequests or covered gift, I mean, the person receiving the gift pays it, so they get $500,000 less the tax. That's a big difference. Mm-hmm. And so there's major differences between how U.S. people are treated compared to covered expatriates. Mm-hmm. And so it's important to keep that in mind when you're planning with a client, what's the best for their situation. All right, sorry, back to you.
I think you mentioned that the goal of the covered gifts and bequest tax is to make sure that the tax that would have applied to the covered expatriates had they remained U.S. citizens are duly paid. So that's why the U.S. Imposes this type of new tax or different tax on the recipients to make sure that the taxes are duly paid after the expatriation of certain individuals. And they actually recently, in January 2025, passed some regulations on how reportings are required, including the Form 708, which is required to be filed by the U.S. recipients. So something to keep in mind for those who expatriate, and also something that they should tell their potential descendants, children, other relatives that they consider gifting to or inheriting to. So, Chris, let's talk about some post-expatriation continuing obligations and any other planning opportunities that we can present.
Yeah, I think we talked about the continuing obligations with the non-resident comparison. But yeah, for planning opportunities, can we plan to avoid the covered expatriate status? And you can. Part of my business is I sell suitcases to clients, and I just say, put cash in it and fly away with it. Joking aside, it's a little more complicated than that. But by planning ahead prior to renouncing your citizenship or green card status, there are plenty of planning opportunities. Remember, you have a $14 million gift tax exemption. Let's say you have $10 million in assets. You could gift away enough assets to get underneath the $2 million net worth test. Mm-hmm. Or if you're subject, and so you can use your gift tax and estate tax exemption while you're still a U.S. person to try to get below, especially if you're a U.S. citizen. If you're, if it's the income tax test that's causing the issue, take a sabbatical for a few years. Just don't work. Mm-hmm. And that, it's an average, so drop that average. And then for green card statuses, so this one's an intriguing one, is you have a residency status for income tax purposes. For substantial presence, a day count. Green card, you're automatically a U.S. tax resident. That's the income tax residency test. For transfer tax purposes, while green card status is a strong presumption factor in determining whether you're a U.S. tax resident for estate and gift tax purposes, it's actually based on domicile. And why is this important? Sometimes people have held a green card and been outside the U.S. for a number of years. This is even more prevalent because of COVID, where they couldn't even come into the country for a while. Flights weren't really going back and forth, so people started working more remotely. It was harder to enter different jurisdictions. And so what you could do, if you're over the $14 million exemption amount, you can make some of your assets foreign. And if they're treated as foreign for U.S. estate tax purposes or gift tax purposes, you could then gift it away, probably significantly more than the $14 million exemption. And so while for income tax purposes, this person is being treated as a U.S. tax resident, for estate and gift tax purposes, they're being treated as a non-resident. And you can use those rules to your benefit and try to plan around the tax. Now, if you have a lot of U.S.-based real estate, it might not be realistic. And part of this is, you got to look at the assets to properly plan. So there are planning. It's very specific to the client's situation. So it's important that, A, the client tells you what they actually have. Sometimes, we need to know the facts. Sometimes you get the facts, they dribble in. It's important to have it all right up front so we know everything.
Thank you, Chris. So understanding the exit tax and the related provisions is really important for those who are considering expatriation, because it can have a lot of ramifications, not only for the covered expatriates, but their children, grandchildren, and any other U.S. recipients. So the financial impact can be significant. Maybe they have a lot of assets that might be subject to the exit tax. So they need a plan to pay it over a number of years, deferring it, or they just can't afford to pay it one time. So I think it's really highly recommended for anyone considering expatriation to engage tax and legal professionals who are experienced with this type of tax and facts, so that they can ensure compliance and to explore potential strategies. So please contact us if you have any questions on what we discussed today. And thank you for joining us, and stay informed, and see you next time.
We hope you enjoyed this episode. To stay up to date with the latest legal insights and Basswood events, please follow us on our Basswood Counsel LinkedIn page and visit our website at www.basswoodcounsel.com. Thanks for tuning in, and we'll speak to you next time.